monochrome Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider monochrome.
Hello, welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us here at ausbiz. So let's take a look at what happened overnight. Global markets, well, plenty to digest in the wake of the attempted assassination of Donald Trump and further commentary from Fed Chair Jerome Powell. Stocks on Wall Street closed higher while bonds were mixed as markets saw the likelihood of a Trump victory at the November election increase following the attempt on his life. Goldman Sachs shares advanced as it reported second quarter profit had more than doubled, beating analyst estimates on solid debt underwriting and fixed income trading. Apple surged to another record high after the tech giant was named a top pick at Morgan Stanley. Shares of Macy's fell heavily after the department store scrapped buyout talks with Ark House Management and Brigade Capital. And shares of Trump Media and Tech soared on the prospect of a second Trump presidency, with crypto stocks also faring well. And Tesla shares jumped after Chief Executive Elon Musk publicly endorsed Donald Trump following the shooting. And gun makers and ammunition stocks, Smith & Wesson, Sturm, Ruger and Ammo all surged, whereas US-listed shares of Chinese companies fell, with the likelihood of tighter trade restrictions under another Trump administration, and renewable energy companies also suffering. Meanwhile, in Europe, luxury companies weighed on markets there. The world's biggest watchmaker, Swatch, reported a steep fall in first half sales and earnings, and Burberry shares plummeted after the British luxury group warned on profit and scrapped its dividend. Well, Federal Reserve Chair Jerome Powell has said the central bank has more confidence that inflation is returning to the Fed's target in a sustainable fashion. He said, what we've said is that we didn't think it would be appropriate to begin to loosen policy until we had greater confidence that inflation was returning sustainably to 2%. The three readings in the second quarter, including the one from last week, do add somewhat to confidence. Meanwhile, US politics continues to dominate the headlines, with Donald Trump officially nominated as the Republicans' candidate for president at the party's national convention, and he's chosen 39-year-old Ohio Senator J.D. Vance as his running mate. Longer-dated US bond yields have risen on the assumption that Trump policies of more tax cuts and less regulation would add to government debt and inflation. The US two-year Treasury yield close to 4.45% and the 10-year at 4.25%. Markets now pricing a 100% chance of a rate cut a cut in the Fed funds rate by September. And the US dollar has fallen from earlier highs following Jerome Powell's comments. The Aussie is trading at 67.6 US cents. So let's get across all those market movements. To do that, we are joined by Steve Sosnick from Interactive Brokers. Steve, welcome. Much to talk about, of course, given the politics there is dominating both the headlines, but also markets, it would seem too, given that Trump trade that we've seen.
Yes. Good morning, Andrew. It's definitely, obviously with an assassination attempt, and then the Republican convention beginning today. It's been really all politics all the time. It's essentially all I've talked about for the last 36 hours. Got a lot of calls over the weekend about what to expect. That sort of thing. The bottom line is, I think the market, when I've talked to political consultants who I know, a lot of them actually feel that the Trump effect will fade. In U.S. politics, 3.5 months is an eternity. And, basically what we're going to see now, especially with J.D. Vance as the vice presidential nominee, is kind of more of the same. So I don't know that they're going to be able to sort of resist the sort of rhetoric that has been very divisive here in the U.S. And I think sort of whatever good feelings the former president gets, as a result of an attempt on his life. And I think there is a lot of sympathy and relief that it was not worse. But there's a feeling to me that it sort of fades. And I think if while we saw big moves in certain sectors, which you pointed out, um, the broader market didn't really react to it. I think today's movement up was more just a function of just the ongoing momentum. Let's say the Apple upgrade. I mean, you saw Tesla. You showed the chart. It got off the gate strong and then faded. The Treasury yield curve definitely steepened a little bit, but not in a big way. 4 to 6 basis points. So I think that it's a little bit of a muted move. We saw no change in the VIX futures curve pretty much at all, and so that's kind of, to me, the tells. Those were going to be were the VIX futures going to move? They didn't. And would the yield curve steepen appreciably? It did, but not it did, but not appreciably. What you're showing here is the VIX futures curve, and you can see that it basically moved. I'm looking at that little bump there, which is October. October VIX is the period that covers the election because they expire mid-October. The November VIX futures, which look out 30 days, expire after the election. So that little bump there has been there since the futures were listed, and it really didn't change today. So it's not telling us anything new about market perceptions about volatility, either coming or going around the November election.
Is that somewhat counterintuitive, Steve? Would you not expect the volatility would increase as you head towards the election?
You would, and that's why that was kind of the tell there, was it didn't change very much. I think there's certainly a bit of a bump priced in, because again, I still believe the race is too close to call. The odds of and and so let's see where this takes us.
Now, of course, this is all overshadowed earnings season, which did get underway on Friday, of course, beginning with the banks. What have you made of what you've seen so far?
Okay, my standard caveat applies. I don't love that the banks go first. You and I have discussed this over the past couple of years. But I guess what we saw so far is the banks seem to be doing okay. The market didn't like J.P. Morgan and Wells Fargo on Citi and Citi on Friday. They seem to warm up to them today a bit. Market liked Goldman Sachs, but they didn't love Goldman Sachs because a lot of it was predicated on trading gains, and investors tend to look through the trading gains. One thing that I think got a little bit underreported was actually Delta Airlines went. They reported on Thursday, our time, a little bit ahead of the banks. And those results were really not well received. The stock was down about 9 or 10%. And I think the fear is that you're not seeing a lot of leisure travel. Some of it has to do with people not going to Paris ahead of the Olympics, but I can't. That's not enough to move an entire airline down by 9%. And so I think we're starting to get into a little bit of a nervousness where you have a bit of a bifurcation among the consumer sector. I think, for better or worse, this is a very crude way of putting it, the haves and the have-nots. I don't know what percentile of the income, distribution we're talking about here, but those in the lower percentiles are getting stretched. Inflation's been taking its bite. Wages have been going up, again, faster than prices, but people don't feel very happy about it. And I think people had been spending a lot. They'd been sort of dipping into the savings, and the savings, to a certain extent, haven't been replenished. At the upper end of the spectrum, those are the people who have money to invest, and presumably they've been buying NVIDIA with it and feel great. But, it's definitely started. But even when we saw today from Burberry and Swatch, that may be starting to bite. I do think the consumer may be getting a bit more nervous or starting to tighten their belts a bit. Not enough to upset things. We'll know more of that when we hear from the likes of like Coke and Pepsi and McDonald's and Kimberly-Clark and Unilever, those kind of companies, and find out if they've been able to continue passing along higher prices, which they were crowing about a couple quarters ago, or if they have to start cutting back, focusing more on value, and really seeing some of their customers getting squeezed. That to me is going to be a very big tell about the health of the U.S. and even global consumer.
Yeah, well, that's very much at play here too locally, Steve, where we're seeing the wealthy boomers continue to spend, and perhaps at the expense of the millennials and the like, who are complaining that that's the reason why interest rates are so high still.
Definitely a global issue. I mean, I hear it. I hear it here all the time.
So, Steve, what are you seeing with momentum on the US share market? Then, where to, particularly for that, as we've spoken about so many times, that narrow leadership we're seeing among those mega caps?
It has started to broaden out a bit, but in some ways, what we saw a couple of times last week was that the broadening wasn't actually all that helpful. What we want to be careful of is a situation where the rotation is out of the mega caps and into the value stocks or the small caps, because the Russell's been doing terrifically, kind of in spite of the weaker economy, but still that's more on rate predicated on rate cuts. But I think I think that what we saw was a little bit of a warning sign where we had some days where some of the mega cap tech stocks sold off, even though the advanced decline line was firmly positive, and that was enough to drag NDX and SPX lower. That's okay if it happens once in a while. That's rotation. That's kind of what we'd been hoping for. The problem is if it persists too aggressively, that's got a very negative effect, because people have been putting their money into S&P index funds, among other things. But if you've been buying, spiders or an S&P index fund, 35% of your money is going into about 8 stocks, and they're all the mega cap tech stocks. And that becomes a problem, because if people start to exit those, it's going to weigh on the index and give the perception that the stock market is doing poorly, even if it's not necessarily doing so. That's where the trick comes in. And that's where earnings season becomes very important, because if any of these big stocks stumble, that can have a very, that could really impede the progress of the market. As of now, again, as long as the good news keeps rolling, in these big cap tech stocks, if the likes of a Morgan Stanley upgrades Apple, well, that's enough to carry much of the market higher. But if we start to hit a point where these stocks falter, that can actually be a negative, even if we start to broaden out the rally.
Steve, terrific to get your analysis. As always, thanks for joining us from Interactive Brokers.
My pleasure as always, Andrew. See you soon.
So let's focus locally. Just before we get going on the open, this is where we're likely to start fairly flat there, marginally negative, according to SPY Futures. So stay with us, as the open is just a couple of minutes away.